Kia ora koutou katoa, nō mai haere mai. Welcome. Welcome to all of those of you who have joined us here today in person, and welcome to you who have joined us online as well to talk about our May monetary policy statement. Joined as usual by some familiar faces to you all by now, Karen Silk, Assistant Governor, and Paul Conway, Chief Economist.
Kia ora.
Also in the front row here we have the other fellow members of the Monetary Policy Committee, Professor Bob Buckle, Professor Prasanna Guy and Carl Hansen joining us as well. Today as a committee we voted to lower the official cash rate by 25 basis points to 3.25%. Annual CPI inflation rose in the first quarter to 2.5%. Measures of household and business inflation expectations have also risen. However, core inflation is declining and there is significant spare capacity in the economy. These conditions are consistent with inflation returning to the midpoint of our target in the medium term. The economy expanded in the first quarter this year following a contraction last year. Higher agricultural export prices and lower interest rates are supporting this recovery. Internationally, developments look likely to lower global growth in the horizon ahead of us. Both high tariffs and elevated policy uncertainty is likely to weigh on domestic economic activity and inflation pressures. However, there's considerable uncertainty around these judgments. To sum up, inflation is in the target range and the committee is well positioned to navigate both developments domestically and internationally to keep inflation pressures at target in the medium term. Before I open it up to questions to the committee, I just wanted to reflect briefly on my first full round as chair of the Monetary Policy Committee. The first point being it provides considerable confidence to be able to make a decision as a committee, working together as we have over the last 6 years through different economic conditions. The second is that we are tasked with seeking to form a consensus in setting the official cash rate. You'll see from the decision this round, we voted. Our process is set up to form a decision by consensus. We are literally locked in a room for a week and a half to work it through. What I'd say about our decision to vote today is that it's a healthy sign of our process. It is not unusual to have to vote, particularly at this point in the economic cycle. If you look at the last time we voted was 2 years ago when the official cash rate was near its peak. Through turning points or inflection points are the times that we are more likely to vote than not. It also reflects the degree of uncertainty that we're dealing with at the moment, and different members of the committee will naturally place different emphasis on those different risks and uncertainties. And to reflect that environment that we're in today, we published a number of alternative scenarios. That's the first time we've done that for 5 years now, just reflecting that global environment. And the key outtake from those scenarios is that there are many different paths that the official cash rate could take from here, but we're in a very good spot to navigate it as developments play out. So with that by way of background and context, I'll open it up, and if you provide your questions to me initially, I will bring in colleagues as appropriate.
Thanks, Matthew Brockett from Bloomberg. Your forecasts indicate at least one more 25 basis point cut, but as you say, you still had to vote today on whether to cut it all. Could you just perhaps put the two together and tell us whether you do have an easing bias, whether you would expect in the current environment to deliver another cut in the coming months?
So we did form a consensus around our set of projections that we published today, and that included a central projection for the official cash rate. That factored in our overall assessment, which was particularly from the international environment, that there would be less inflation pressures than there were back in February, and that reflects how that projection was revised down. We also acknowledge that there is a high degree of uncertainty around that. That is just one central projection. There are many other paths the economy could take, and the confidence ranges around that central projection are wide enough for us to not have a bias either way in terms of what the next step is at the next meeting. It will be dependent on developments, and in particular what those developments mean for medium-term inflation pressure in New Zealand.
Can you just talk through, for those who might understand, why a vote had to take place today compared to what you would otherwise do?
So, thank you. So we are tasked with attempting to make a decision by consensus. That's reasonably unique internationally. In other jurisdictions, there's an expectation to vote at almost every meeting, and that tends to be the way they develop. If you have that approach, you tend to have committee members that walk into the room with set views about the decision they want to make, and they, give their speech about why their decision is the right one, and they vote. We are very different in the sense that we walk into the room together with an open mind, and our job is to absorb the information from staff, ask questions, and collectively develop a picture of what we do see as the outlook going forward and the risks. And all going well, by the end of that process, we've come to a collective consensus decision. That won't always take place, so that there is this ability to vote if needed, and this is one of those occasions.
And just a follow-up question. How much did the government's, lower spending contribute to your decision today?
We were delighted that the government announced its budget before we met as a monetary policy committee, and that meant that we had all that information in front of us and we could take that as given. It had a very little role to play in terms of the decision we made today relative to previously. There were unders and overs in terms of the impact of the budget, the investment boost scheme providing some support to business investment, and that's factored into our projections, but on the other side, some active decisions around reducing government expenditure. They effectively net out, and it remains the same story that government spending as a proportion of potential output is looking to be falling through our projection period.
Hi, Dan Brunskill from nzherald.co.nz. I have a follow-up question on the budget. One of the changes was an increase to the default KiwiSaver rate, which presumably will incentivise more people to save money and mean less money washing around the economy. Did you think about that in your projection at all, and do you expect that to be a disinflationary force in the economy?
It was something that we were aware of, but our assessment was that it was a very small effect relative to the aggregate consumption.
I also wanted to ask about the increase in inflation expectations that's referenced a few times through this document. It almost seems contradictory with the weaker economy. What do you think is driving that inflation expectations higher, or when the output gap is still so negative?
Yeah, thank you. That's a great question, and something that the committee spent a considerable time discussing and reflecting on. There's a few things going on here. One is that when headline inflation increases, you do typically see short-term inflation expectations rise around that, so it's not an unusual occurrence. What the committee had to think through is that how much of what's going on is related to persistence in inflation, having come out of a period where we've had inflation above our target range for some time. So how much does that affect people's inflation expectations when they see headline inflation rise, and when they open the newspapers and read lots of things about tariffs going up globally and the effect that that can have internationally. So they were considerations, something that the committee focused on a lot. For some members, put more emphasis on the risk that those higher inflation expectations might be a sign of something more persistent. Other members put more emphasis on the amount of spare capacity there is in the economy, and therefore inflation pressures likely to come out. One of the things we were keen to do in the document was provide some education that just because tariffs are rising in China and the US doesn't necessarily, yes, that will put upward pressure on prices on those areas that impose tariffs, but for the rest of the global economy there are many different channels that this works through, and in net we think it actually reduces inflation pressures here in New Zealand largely through having a weaker global economy, less spending power to buy our goods, and also through the impact that it's having on confidence through the policy uncertainty, tariffs going up and down every other day, the effect that has on businesses making medium to long-term decisions.
Giles Beckford, Radio New Zealand. You say you don't have a bias to either raise or ease, but you say there's spare capacity, you say that there's lower growth. Your forecasts point to at least 6 to 9 months of insipid growth at best. You say that core inflation is coming down. Aren't you open with this sort of decision to the charge that you're actually impeding economic recovery and that you should actually have an easing bias?
So our job is to work to our mandate, the mandate that's provided to us, and that is achieving our inflation target. And so we need to look at everything through the impact that it has on that ultimate objective. And so to the extent that the economic environment, if there is lower growth, the question is how much does that influence the likelihood that inflation's going to be at the midpoint of our target in the medium term. We highlight in the document that yes, there are parts of the economy that are doing it tough at the moment, there are parts that are struggling, but there are other sectors that are doing well. High agricultural export prices are supporting that part of the economy and the economy more broadly. We also highlight that we have lowered interest rates a considerable way over a reasonably short length of time, and that is going to support the economy, and it's still working its way through as those effects work their way into effective mortgage rates and the like.
And if I can just follow up, your forecasts are for inflation to nudge a little higher, but to stay within the band. Is it your view that the inflation spike is temporary, or do you have concerns that it actually may become slightly more entrenched and harder to move?
So our core view is that inflation will return to the midpoint of our inflation range, and that is based on those things that we've highlighted around core inflation having trending lower and there being spare capacity there in the economy, which will take those pressures out. We do highlight, though, that there are risks around that. And with inflation in the top half of our target range at the moment, there is a chance with just the volatility that you see in month-to-month, quarter-to-quarter data that we are at the top of the range or tip over the top of that 3% range. There is a chance of that occurring. There are also risks around inflation expectations there as well. So these are the things that we are balancing as we work our way towards a decision. And the great thing about monetary policy is that you get to all get together every 6 weeks and see what's happened in the meantime and work through and revisit your judgments and assumptions.
We'll be back.
Lucy from Reuters. Where are you guys picking neutral at the moment? And if it's still around that 3%, does that mean we don't need to go very far into stimulatory territory to keep the economy ticking over?
I'm desperate to bring my panel members in, so I'm going to let Paul know that this one's
Thank you,
coming your way, Paul. Something we did talk about a lot
thank
over
you.
the period.
We did, and it sort of makes sense to use that sort of restrictive north of neutral, when you've got inflation at 7-point-something%. Now, with the OCR at 3.25%, we are definitely into that zone of neutral. Previous work at the Reserve Bank has sort of indicated that that's around the 2.5 to 3.5% mark. I made a speech on this not so long ago, just sort of saying that when you get close to neutral, which is definitely where we are now, it's more a matter of sort of feeling your way rather than being too definitive about yes, policy is stimulatory or otherwise. So that's very much the world that we're in currently, Lucy, with the rapid cuts in the OCR the Governor mentioned. We've done 225 basis points since August last year.
And for all of those reasons, that's why you'll probably hear us talk less about neutral at the moment, because it's plays a lesser role in our decision making.
It's more feeling our way. Like what effect are we seeing of interest rates on the economy, instead of being certain that we're being restrictive, et cetera, et cetera.
So looking at the projections from today, are we almost there? Job done? 2 years of just holding it where it is, you guys can put your feet up?
That would be a lovely world to live in. We will keep turning up every 6 weeks and reassessing the situation. The key message is that we have done a lot of work, we have come a long way, and we're in a good position such that we can respond to developments as they occur, as opposed to being pre-programmed or preset to make any particular move.
Thank you, Governor. Luke Malpass from The Post. As you said, it's your first full cycle through. Obviously, you're new Governor. I was just wondering if you could reflect on what you found most interesting, difficult, or eye-opening, stepping up into the top chair.
Well, I think it's very much business as usual around the Monetary Policy Committee table, I'd have to say. I've been a committee member since we first formed 6 years ago, along with Professor Bob Buckle. We are the two remaining originals from the original set of MPC members, and through that period we've built a really great culture of working together and honed our processes through that period. So it's been very much business as usual. Each time you show up to the committee, there is a different issue or challenge that you're navigating. We're supported by an amazing team of staff who I think produce world-class material, some of them in a couple of special topics in the document. Then as chair of the committee, it's my job just to keep things moving along, following the process and getting to that decision point. And I was very comfortable calling for a vote because I felt that it was the right thing to do, given the way that the discussion had progressed and the situation that we're in at the moment.
And aside from you being the chair of the committee now, have there been any other changes or differences since the rather sudden resignation of your predecessor?
We have a large, complex mandate as a central bank. There are many other moving parts to what we do, from monetary policy, financial stability, our general role as the central bank running the cash system, payment system, all of those things. We're also going through a period of change, obviously, at the moment with a new governor in place, and so it's a really big focus on our people through that period of change.
Can I just add, I think the fact that financial markets didn't skip a beat when we swapped governors really speaks to the value of having monetary policy set by a committee. It's definitely been business as usual around here the last few months.
Hi, Jenny Ruth from Good Returns and Just the Business. You've still got unemployment peaking at 5.2%, but staying higher for longer through the forecast period. What are the factors that make you think that it won't get any worse than 5.2%, given that unemployment tends to lag activity?
I'm going to bring in Karen here.
Yeah, so those forecasts are based on, it's effectively an outcome of the total forecast that you've got sitting there. So over the next 12 months, what we're seeing is a narrowing of the output gap, so capacity pressures increase. Got to work around the other way when it's on that. And that's a reflection of the lower interest rate, the lag that we've seen in that, the pass-through of those lower interest rates flowing back through to the economy and activity picking up. And as you have that, then you will start to see employment pick up off the back of that as well. So it's really a reflection of the flow that you would normally expect to see come through.
So we've still got growth in the economy. Granted, it's mediocre over the next few quarters before it starts to pick up towards the end of this year.
Yeah.
So that makes us think that unemployment is near its peak, 5.1 currently. I think we've got it peaking out at 5.2. We have it hanging around those levels for a bit longer than we did in February, essentially because the spare capacity pressures in the economy that Karen was talking about has sort of been elongated into the future, primarily as a result of tariffs and uncertainty.
And that certainly is an area of risk. If we were to see the international scene worsen, then there is a risk that it's either could move slightly higher and or be prolonged for longer.
Janae Tibshirani from the Herald. Just for people watching at home, they might be equally as sort of confused by the situation as the rest of us are, just in terms of all the volatility, in terms of global events. The market is also very volatile, and the statement has really highlighted all the uncertainties. What impact do you think your decision today will have on mortgage rates if you look at all the factors and put them together?
Again, I'll pass to Karen on this one.
Our view is that the decision we made today is pretty much already baked in to mortgage rates. There's a lot of factors beyond the OCR that obviously feed in to mortgage rates, and you've highlighted some of those things. Market volatility, global uncertainty can have an impact on bank funding costs, which are obviously one of those key drivers. So there is that impact that is still there. But likewise, we're also in a very low credit growth environment, and during that period you tend to see greater competition being driven through price across the banks as well. So while you might have some potential risk on the upside to bank funding costs, you've also got a very low credit growth environment and competition on the downside. Our view over the last 6 months has been that mortgage rates were in that 5 to 5.5. We're probably reflecting fixed term mortgage rates were that probably reflected about where we thought they would land. They are slightly lower than that, and I think that does reflect that increased competition that we're seeing in market at the moment in that low credit growth environment. So our expectation, and we're already starting to see it, is that we'll see homeowners start to move out back into that 1 and 2 year kind of level, and as that happens, I think that's where you'll start to see it settle. Certainly without some extraordinary shock offshore driving it lower.
And just to sort of answer the question more broadly as well, in terms of the impact of these global developments on us here domestically, I think this table here, table 4.4, which is part of one of our special topics, effectively traces through all the different channels that this global trade shock affects New Zealand, and you can tell which ones are definitively which one way and which ones are ambiguous, and it also helps you trace what information we as a committee need to focus on as we go forward to become more definitive about how it's affecting New Zealand.
It's a beautiful piece of analysis. Please read it. If you do want to understand the effects that tariffs are going to have on New Zealand through different channels, that few pages sets it out very, very clearly. And you sort of put it together on net. We're seeing it on net as a sort of negative global demand shock as being the sort of dominant impact on New Zealand, which is why we're saying we're a bit softer on the growth and a little less inflationary pressures in the system.
Sure. Just a related question. The statement mentions that the committee discussed the LSAP and the impact of volatility in bond markets on that. Could you just elaborate on what was talked about?
I think that's just a standard thing that the committee does, just to have we get briefed on a range of different things, just to have an awareness about those factors, including a briefing from the financial stability team, a briefing from our financial markets team. We were conscious that through the period of April that there were some strains in global wholesale interest rate markets, and so what we needed to do was sort of understand how much of that was affecting our local environment and whether there was any implications for us. The overall assessment is that liquidity conditions were strained for a while but are now not impeding the monetary policy transmission, and that's ultimately what matters for the committee.
Sorry, just have one more question. Just in terms of Adrian Orr's resignation, could you please shed some light on why the resignation was announced, I believe, according to documents, a week before it was planned to be announced?
You're going back a long way now. It's a couple of months ago. I think my understanding is that it was announced when Adrian decided to resign. It was announced, and that turned out to be the night before our conference.
It would appear it was a hurried decision. I just wonder if you could provide any more insight into what happened.
You'd have to ask Adrian about his decisions.
Lucy from Reuters again. Rates are rising sharply after the decision. Is that what you guys were after? Is it something that's going to concern you?
I haven't looked at the screens, so try not to look at screens too much. I think it's important that we take a medium-term perspective. I think often it takes a bit of time for decisions to be digested. It's a long document. I think the key, our official cash rate projection wasn't a long way from where my market pricing was leading into our decision. Key message for markets is that we're well placed to, navigate developments from here.
So the Kiwi hasn't fallen as much on a sort of longer term as it maybe usually would during periods of global instability. Has this become sort of an unwelcome drag on the economy in your view?
We take, from a mechanical point of view, we don't project a particular direction for the exchange rate. We take it as given. What we notice is that the exchange rate is considerably lower than it was before we started cutting interest rates. So the exchange rate has worked as a buffer to global developments through that period. We're very conscious of the discussion around the role of the US dollar as a reserve currency and whether that's going to mean that it or not, and whether that means it's going to behave differently in the future. That is a discussion that is quite a medium to long term type view and may take time to play out. Again, we have the benefit as the committee to see how that goes. And if the exchange rate doesn't act as a buffer in the way that it should, then it gives us the opportunity to put that in the mix into our decisions.
And you're now through your first full meeting, 2 meetings in. Do you want the job long term?
I believe that there's a job advert out there. I haven't had time to dust off my CV yet. I've been quite busy on other things. From my perspective, the really important thing about the appointment of a 5-year term, Governor, is that it's an open, transparent process, that we get absolutely the best candidate that we can for the role, because the legitimacy of anyone in this Governor position at the bank is crucial for us in terms of the trust and confidence in achieving our mandate.
Thank you.
Yeah, sorry, I didn't give my name before. My name's Zane Small. I'm with Stuff and 3 News. Just for clarity, so if you couldn't find consensus today, how are you projecting further cuts to the OCR?
So we had a consensus around the set of projections that we put together, and that includes all the different moving parts there are in a projection. So committee members were comfortable with that projection. There wasn't a consensus on where to move the OCR today. So that's differences of views and emphasis on timing around how you might get there.
Yeah.
So that's the difference. And then, of course, we meet again, and we can see in the future if we form a consensus on decision next time.
And was it those global headwinds that were the main concern?
There are a number of factors in terms of why a consensus wasn't formed. So we spell it out in the record of the meeting, both the case for cutting the OCR, which was around the points that I've already made in terms of core inflation falling and there being spare capacity. The case for holding was more around inflation expectations and how persistent they were going to be, and also the fact that we've cut the official cash rate considerably over a short period of time. We're still learning how much that's working its way through.
Hi, Dan from Interest again. I just do want to go back to Adrian Orr's departure. Can you confirm for us that the information that is currently in the public domain about his departure is a complete and transparent picture, and there's no further information the bank has that the public might need to know?
I'm not aware of all of I can't keep track of everything that's in the public domain. I know that we are still, there's a number of official information requests that are still, that are with us. There have been, I don't know the exact number and how to scale it, but many, very many, keeping our teams busy. We need to follow a process and consult and, work through things to provide accurate information. So there will be more information coming out in future as we work through that.
Do you accept that Adrian Orr's, the abrupt nature of his resignation, not the resignation itself, but the abrupt nature of it, has been a net negative for the Reserve Bank's reputation?
I think for us it's, business as usual. I think as Paul has emphasised, it's part of the Adrian was an important part of this committee for a long period, and we work together really closely, but it's the nature of a committee that we are able to work together, cover each other, have new people come in and out of the committee and work seamlessly. And so that's been our objective, and Adrian has prepared us well for the period where he's no longer with us.
Would you say that his resignation has been a net positive then?
I wouldn't dare say anything like that. I have no comment on it's his decision, and I wish him well, and I know he's very happy.
Any final questions on the statement?
All right, on that bright note, we will wrap it up. Thank you, everyone, for joining us, and we look forward to seeing you again next time. Thanks, everyone. Cheers.